Overnight, the US Federal Reserve decided to cut interest rates by 50 basis points. Now, prior to the meeting, expectations in the market were broadly balanced between a 25 basis point cut and a 50 basis point rate cut. But the Fed has effectively endorsed the view that they're now pivoting to fully being focused on making sure that the labour market doesn't loosen unnecessarily, and they're less concerned in the near term with inflation dynamics. So what are the implications? Well, ironically, what has happened is that the Fed dot plot is still coming in inside the market's expectations for future rate cuts. So they expect another 50 basis points for the rest of this year and 100 for 2025. At the moment, the market expects a further 75 this year and 125 of next year. So there's potential actually for some rate cuts to be gradually priced out. So we may see some pressure on bonds, having rallied so well in the last few weeks. You could see bond yields rise a little bit in the short term. And with respect to equities, the initial reaction is likely to be positive. The Fed has signalled quite a dovish intention here. And equities, having seen a volatile month so far, could see in the near term some buying flows coming in. But ultimately, the Fed will also have signalled that they are slightly concerned with recent data pertaining to the labour market. And so once equity markets take pause for thought, they could see some selling pressure, given that the outlook has dimmed somewhat both for the labour market and more broadly the economic cycle. Now, with respect to the Asia region, this creates opportunities for Asian central banks to restart their rate cutting programs. So we saw Bank of Indonesia restarting their rate cut cycle early this week because they had full confidence the Fed was about to embark upon their own rate cut cycle. And the Central Bank of the Philippines may also be next in terms of cutting rates. This effective exporting of monetary policy easing into the Asia region creates opportunities for policymakers in some of these markets to stimulate their own domestic economic cycles. So whilst the dollar has seen a period of weakening in the last few weeks, given that rate cut pricing, there is a bit of a mismatch between the Fed signalling and the market, you could see some near-term resilience in the US dollar. But as central banks in the region continue to enable themselves to cut rates and to support their growth cycles, capital flows may also start to come back into the region, which should see a bit of a modest appreciation for Asian currencies and therefore a resumed period of softening of the US dollar as risk appetite broadly increases.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。